Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, what we're going to do today, guys, is I'm going to bring up a report and we're going to go through an article from Fortune magazine that's going to go over 27 research companies and what their forecast is moving into 2023 as far as what's going to go on with the housing market. So they're going to go into what they think as far as median sales price is going to go down to in 2023. And again, you guys, that's 27 companies. And the crazy thing about it is, out of these 27 research companies is most of them have different answers and different reasons for what they come up with. Now, I agree with a lot, I would agree with some of them, you guys, but some of these people's projections and the reason why it to me is absolutely outrageous and really doesn't make any sense. So we're going to dig into that today. Now, other than that, guys, understand this is a live video. This is going to be recorded raw. Towards the end of this video, I'm going to do live Q&As, which is my absolute favorite thing to do. I really love doing it. It allows me to basically just answer some of you guys' questions and really see, what you guys want to talk about and just really relate with you guys. So let me know if you guys want me to continue to do, these live videos, the Q&As, because honestly, it's my favorite thing to do. I really like helping you guys. I love talking about credit, mortgage, all of those things. Okay. But other than that, guys, do me a favor, like this video, subscribe if you haven't, hit notifications. I know this is live. Do me a favor. Just go and hit the like button real quick and share it if you can. But regardless, guys, we're going to jump into this video right now. All right. So the name of the video, the name of the article is "Something Big is Happening in the U.S. Housing Market." Here's where 27 leading research firms think it'll take home prices in 2023. So I was going to actually make a video like this, guys, going over each of the research firms and then basically kind of outlining what were they saying and then why were they saying it. But the beautiful thing is this article did all of the heavy lifting for me and actually put them all together because you guys know Zillow, Redfin, CoreLogic, Realtor.com, all different projections. Who do we lean on, right? And that's really why I'm showing you guys this. And you guys know that, I'm constantly saying, listen to everyone, formulate your own plan, your own goals, your own ideas, become an expert in your local housing market because everything is different. And I also told you guys, at the beginning of all this, that I don't know what's going to happen in 2024. It's an election year, so stay prepared, right? And again, you guys, there's just so much dust in the air. Friday, numbers came out on Friday, specifically about unemployment. Unemployment, instead of going up, because remember, the Federal Reserve wants unemployment to go up, unemployment actually went down. Shockingly, right? It somehow went down. The market rallied, the 10-year plummeted, it dropped interest rates about 30 basis points, roughly on conventional 30-year. So you guys, it's just so crazy. It's just we cannot get society and the public on board with the reset. People are still spending money like crazy. So I hope this helps, guys. This article is linked in my live chat. And again, what I may do after reading this article is I may send the link to the live chat so you guys can hop on video if you want to. So far, nothing has gone wrong. Obviously, it's really dangerous for me to do that because it's live. But honestly, guys, I don't even care. I just want to take you guys behind the scenes. I want to get raw. I want to get on the street. And I want to just get to the root of your questions. So, don't embarrass me if you do come on. No one has yet. Now, let's go on here and start this article. So here's where we're at, guys. I'm just make sure real quick. So I left Johnny's comment here on the screen here because my man, I want to tell you about Johnny iFly and I'm going to get started, but you guys see this here. You guys, I love Johnny. Okay. Johnny's on our team. He's just like, he's our troll. He's reverse trolling, right? Like I love Johnny. He's trying to make me nervous. He keeps me sharp. I don't mind him trying to keep me nervous. I actually like it because it helps me be focused. But Johnny, I just wanted to say, I love you too, man. I love you too. I love all you guys, to be honest with you. I love you guys so much. Annie, I don't know if you're listening. Annie, I'm proud of you. Good job, on all the stuff you went through. Really appreciate you, Annie, for trusting me. But let's go on here, guys. The U.S. housing market is no exception. The streak of 124 consecutive months of positive home growth. Okay, so 124 months of positive home growth is what we came out of, right? A period spanning from the bottom of the previous bust in February of 2012. So home prices have been essentially going up from February 2012, you guys, to June 2022. Okay, so 10 years of straight going up. right? So, and that is traditionally why real estate is such a great investment. And you guys understand that I believe that investing in real estate is smart. I think we should all own a house and not rent. But I'm also saying that right now in the specific time, caution is definitely needed, in my opinion. And, emotions definitely need to be checked. We're in a rare situation that I believe, and we're seeing it in the data. The longer we wait, the better deal. But again, going back to this article, this is really refreshing, guys, because remember, just about 9 months ago, nobody was expecting negative equity loss. Absolutely no one except a handful of YouTubers. So fast forward today, we have many people that are doing this now, okay? Sorry for rambling, guys. So between June and October 2022, U.S. home prices as measured by the Case-Shiller National Home Price Index fell 2.4%. But remember, you guys, that is a lagging indicator. It's actually much further. It's much lower than 2.4%, but it is a lagging indicator. But let's go on. On the other hand, that's already big enough to count as the second biggest home price correction. Why don't we just say crash? It's cool. Correction on of the post-World War II era. Okay, so think about that. So not only do we have the historical fastest equity deceleration, which was in June, we also had according to the Case-Shiller, which is lagging, the second biggest price correction since World War II. So it's fair to say what the Federal Reserve is doing right now is working. But again, they're in total control, right? And the question is once they pivot, how much will be broken? And how long will we have to buy a house? The more things that are broken, the longer we'll have to buy a house, right? As far as opportunities. So let's keep going, you guys. I'm going to just scroll down here to get to the nitty gritty. Again, here's the Case-Shiller. I mean, it's just so laggy. It's just so laggy, you guys. It's not something that I really go off of, but let's start here. Now, this is a little bit of a joke, and I hope you guys can see this okay. This is shocking to me. We're going to start with Realtor.com, you guys. Now, Realtor.com predicts that the median price of existing homes, you guys, will rise 5.4% in 2023, while mortgage rates average 7.4%. Okay, the slowdown in home sales transactions that begun as mortgage rates surged in 2022 is expected to continue, leading to a moderation in home price growth and tipping housing market balance away from sellers. Here's the thing, you guys. So they're saying, and this is why I'm a realtor. I hate Realtor.com. I don't hate Realtor.com. I just think they're a cheerleading research company. How can they say house value is going to go up and we still have interest rates at 7.4? I could understand their point if they say interest rates are going to be down at 4%, but being that they're at 7.4, it makes no sense to me because remember, you guys, on a national average, according to Redfin, so I'll cite all my informational data sources here. Redfin, according to Redfin, it went down, looking at the peak in June, rates were under 6%. So rates were under 6% in June, and we still had an equity decline. So they're saying essentially rates will be higher, but somehow home prices are going to go up, right? That doesn't make sense to me. I don't understand that, guys. Comment below. Let me know if that makes sense to you. Let's look at CoreLogic now. All right, here's Home LLC. I'm so disappointed in CoreLogic, you guys. Now here's Home LLC. The firm predicts U.S. home prices to rise 4% in 2023, but they give no reason, right? At least you guys, what we're doing on Real Estate Mindset, what you guys are doing, I see it in the comments, we're all doing, at least we're telling people why we think the way we do, right? I'm not one of these people that, just rambles and says, don't pay attention to the details, right? I do ramble, but I'm also saying pay attention to the details. You guys, unbelievable. But look at CoreLogic, such a disappointment. I leaned heavily on CoreLogic, pre-COVID, but look at this. The research data firm predicts the U.S. home prices will rise 2.8% between November of 2022 and November of 2023. So again, you guys, CoreLogic has got it wrong all year with their projections, except maybe at the beginning of the year, because remember, the beginning of this year, on average, we had double-digit equity. 2022, the beginning of 2022, we're in a new year now, but at the beginning of 2022, we had double-digit equity growth. So they were right at the beginning of the year, but CoreLogic has, in my opinion, they've struck out. I don't even look at their articles anymore because I think it's trash. Now, here's NAR, okay? Now, NAR is the National Association of Realtors. The trade group projects the existing home prices are poised to rise 1.2% in 2023, while mortgage rates will average 6.3%. So that's interesting. At least, the rates are a little bit lower. I just don't see it, you guys. Demand destruction. People are crippled right now. Savings are depleted. People are struggling. Defaults are on the rise historically for FHA, from 680 to 719 credit scores. Actually, everyone with above 680 credit score right now in FHA. It's a historical default rate right now. But anyways, let's see what Freddie Mac says. Freddie Mac is Fred economic data. So all of the Fred economic data charts that I use, you guys, is data from Freddie Mac. Freddie Mac is huge, right? They're guaranteeing and purchasing, in the secondary market. But a huge company. I should actually do a video specifically on Freddie Mac and Fannie Mae just to show you guys who they are exactly, because they're huge, right? They're massive companies. The firm's forecast model has U.S. home prices falling. Okay, thank you, Freddie. Thank you. We finally have, you guys, thank God, right? You guys see they're starting to switch now, right? Because now we have the data, so they have to kind of, right? But Freddie Mac finally is saying home prices will fall in 2023 by 0.2%, while mortgage rates average 6.4%. We expect house prices to decline modestly, but the downside risks are elevated. So they're basically saying it can go down a lot more. But always remember, you guys, we're looking at national average stuff, right? I can't say this enough. It is so important that you guys research your own local housing markets. A way to do that is you can go to Altos Research, put in your zip code, and it will give you guys a bunch of data. From there, you guys can go to Redfin Data Center. And then from there, you also can ask a realtor to help you with a market analysis. Okay. Let's go down to the Mortgage Bankers Association. All right. And this is where I went to just to follow up on the interest rates from this morning, you guys. But here's what the Mortgage Bankers Association is saying. The firm's largest forecast has U.S. home prices as measured by the FHFA, U.S. Home Price Index, falling 0.6% in 2023. And listen to this, guys. So they're actually taking it a step further, and another 1.2% dip in 2024. So Mortgage Bankers Association is saying that the negative decline is going to go into 2024. And that's the first time on this list that we have a research, data firm that is essentially saying it's going to spill over to 2024. The group also forecast average mortgage rates of 5.2% and amazing, right? And 4.4% in 2024. Now, here's the thing. Unlike the top, companies, I can respect the fact that they're explaining themselves, right? Inventories of new homes are increasing at the same time that demand has remained quite weak, and more builders appear to be offering price cuts as well as other concessions to move properties, right? That makes sense. Here's the thing, you guys. I am intrigued by, essentially, they're saying that rates going into 2023 will be in the 5%, right? And that is possible. If the rates, let me explain, if the rates go down to in the 5% of 2023, it is still possible that home prices go down because, remember, so many people have already been priced out. Their interest rates essentially are still not doubled, but there's a way higher than they were when they're at 2 and 3% when everyone could qualify. So, and again, people have less money, more debt. There's way more new construction inventory in most metro areas. So I don't know, though. I think 5.2% will be too low, and I definitely think 4.4 is going to be too low. But only time will tell. Let's continue to keep our eyes on the Federal Reserve. But take a look at this, guys. Here's Zillow. Finally, Zillow is saying decline. All right. It took them all year of getting things wrong to finally say, okay, home prices are going to go down. Let's see what Zillow has to say. Economists at the home listing site forecast that U.S. home value will fall from November to November 1.1%. All right, so finally, Zillow, thank you for stepping up. It's probably going to fall. I appreciate you being cautious. I'm sure we all do. Here's Fannie Mae. Remember, it's Freddie Mac and Fannie Mae. So economists at the firm predict that U.S. home prices as measured by Fannie Mae HPI will fall 1.5% in 2023. And here's the thing, you guys, they're going further and saying that it will dip in 2024. And again, remember, I don't know what's going to happen in 2024. And if it wasn't an election year, I would say that for sure the equity decline is going to go into 2024. But you guys know, politics really freak me out. You guys remember what happened over the last 5 years? I mean, look at the division it created amongst friends and family. I mean, you can't judge someone based on two parties. You can't do that. in my opinion. All right. And I'm not getting political. I'm just saying there's a political problem, right? Fannie Mae is currently modeling an average 30-year fixed rate mortgage of 6.3% in 2023 and 5.6 in 2024. I like this. I like this right here, you guys. I can see this right here. Again, I've told you many times that we do not need rates. In my opinion, we don't need rates in the 7% to continue the trajectory of the trends. I think even if rates are under 7%, we will continue the trajectory of the trends as far as inventory going up and as far as prices coming down. Okay, so actually, I think the prices are going to fall a lot more though than 1.5%. But I can see this trajectory of interest rates, and I can, I see if rates aren't in the 7% though, and there are in the 6%, it will be slower, right? It will be slower because the Federal Reserve, you guys, the massive whiplash and rug pull, think about it, right? I mean, on your free time, think about how amazing that actually really was. All right, here's Redfin. You guys, I tend to lean on Redfin. They seem like the most up to date. And honestly, here's the crazy thing about their Redfin CEO, Glenn. Glenn started going on TV being more conservative, about home prices and explaining things. And I was going to do a video where it was a video on finally, Glenn, the Redfin CEO is being cautious, right? So I go to make the video, and the video that he made, which was on a news station, was deleted. And then I've never seen him since. So, the moment that I was finally proud of Glenn, the Redfin CEO, right? And I was going to do a video, gone. They cut him. So, dang, man, because you guys know he was taking a beating. That guy was taking a beating, but he stayed in the hot seat. And that's why I was starting to be like, okay, he's getting it. At least he's in the hot seat. At least he's explaining. And then the moment the truth was coming out, they cut him. Pretty disappointing. But here's Redfin, you guys. The firm's baseline forecast predicts that the median U.S. home sales price will fall 4% in 2023. So we're already down almost 10%. They're saying an additional 4% in 2023. Prices would fall more if not for a lack of homes for sale. So they're citing because of the lack of inventory. Now, you guys, it doesn't, regardless of what we believe, okay, inventory is vital. All right. Obviously, if people can't afford to buy things, inventory really doesn't matter, right? But in a normal market, inventory is really, really super important. So yeah, they have a point there. I'm going to do my Redfin weekly housing market update, guys. Inventory did go down as far as months of supply, which was to be expected. It's a seasonal thing, plus the interest rates being lowered. So really intriguing to see the interest rates play into all this, isn't it? Now, here's another company, you guys, Amherst, the real estate investment firm, which owns a massive portfolio of single-family residences, tells Fortune that its forecast model has U.S. home prices falling 5% from September 2022 to September 2025. So that's not really telling us, specifically what's going to go on year to year, but they're stretching it out, for the next 3 years. Pretty astonishing. Now, here's Wells Fargo. The bank's forecast model of U.S. home prices falling 5.5% in 2023. So Wells Fargo is saying in 2023, another 5.5%. Thank you, Wells Fargo, for at least being semi-cautious, right? Do you guys remember what Realtor.com said? They said 7% rates, home prices are still going to go up 5%. What kind of hopium? Anyways, here's Capital Economics. Peak to trough, the firm's forecast model has U.S. home prices falling 8%. And my other question would be is what data set are they looking at to measure the fall? Because we could tell right here, right? The data sets are all over the place. So who are they looking at? I'm telling you guys, I'm looking at Redfin, right? And so when people talk and they talk about the housing market, it's so important to get the data sources, guys. So good morning, Deuster. Good morning, Jeff, Millie. Appreciate all you guys being here. I really, really appreciate you. I'm a day. Love you. Love all of you guys. I'm gonna get to the questions here soon. Capital Economics, peak to trough. The firm's forecast model has U.S. home prices falling 8%. Thank you, Capital Economics. Do you guys see how it's changing in mainstream media? It's changing, right? Remember, you guys, confirmed recession. Remember that. Confirmed. When do we have the confirmed recession? We can already argue we're in it and we had it, but they're changing the data. You guys know they're changing the data because of look at the GDP reports for Q3. Unbelievable. You guys, they keep changing the data. And on Fred Economic Data, new construction, they keep changing the data. I have all of the proof of this. Here's Goldman Sachs. The investment bank expects U.S. home prices to decline 5 to 10% from top to bottom, with its official forecast model predicting a 7.6% decline. Thank you, Goldman Sachs, for being cautious with our money. I appreciate that. ING, the Dutch bank, okay, so now here's the Dutch bank, tells Fortune it expects U.S. home prices to fall between 5 and 10%. So there's more and more companies. However, the multi-international lender says U.S. home prices could possibly decline as much as 20%. So let me ask you guys a question. What does that depend on? Right? They're expecting 5 to 10%, but they're saying as much as 20%. For you guys that have been watching my videos, what does that depend on? What does it depend on? Shoot it, pause the video, put the answer there if you want. But what does that depend on, guys? It depends on the Federal Reserve, right? Well, and also black swan events, right? But specifically, it depends on the Federal Reserve, not me, not you, not any of these other, realtors, investors, YouTubers, whoever. It depends on the Federal Reserve. It's not an emotional thing, right? It's not a sentiment. It's demand destruction from the Federal Reserve, right? It's not an emotional thing, but that's what it's going to depend on. Again, in my opinion, I'm getting a cell phone call right now. I apologize, guys. I don't know if you can hear that. Now, Bill McBride, a housing analyst and author of the Calculated Risk blog, expects U.S. home prices to fall around 10% from the 2022 peak. The thing is, it's already, according to Redfin, we're already down 10%, but that's all right. I don't know what they're using. But here's the thing. Since national home prices increased very quickly during the pandemic, up over 40%, it seems likely, and I would say logical, that some of the usual stickiness will not apply. I think the most likely scenario now is normally house prices declining 10% or more from the peak and real house prices declining 25% or so. This is crazy, and I can appreciate this over the next 5 to 7 years. Again, you guys, they may be absolutely right. Normally after the pivot, there's years of opportunity. At this time with the data, I don't think so, though. I don't think we're going to have 5 to 7 years. Unless the government makes additional laws for institutional investors and investors. If they do that, maybe. But the demand is there's demand on the sideline. We know that. We can't rule that out, but there's more people that have been priced out, is my point. So don't have fear of missing out, right? Because we're still okay. But I don't think we're going to have years to get a house of our dreams at a great price, right? And that's why I'm always saying, you guys, just stay ready. We don't know what's going to happen. The Fed's in control. Stay ready. Here's Keller Williams. I am shocked. When I read Keller Williams, I'm shocked. And also, you guys, I'm proud. I don't see Remax. I don't see Century 21. I don't see anyone else. KW, them stepping up like this. And I've done a lot of work with KW, and I'm not defending realtors. Remember that. I'm just saying they stepped up. Beautiful. All right. I can appreciate that. Now, at Keller Williams Realty, they expect median home sales prices as tracked by NAR to fall 10% from top to bottom. I suspect we will see the first half of 2023. So they're saying basically the first half of 2023. Isn't it crazy, you guys? Some of these people think houses are essentially, I think the pivot is going to happen in 2023. I think it is. I don't think the Fed's going to go to 2024. I hope I'm wrong. All right. I hope I'm wrong. But just because of how weak they are, I don't think they're going to make it. I think they will flip. But it's interesting that some people think that there's, these research companies, some of them think that there is so much demand on the sidelines that we're only going to have buying opportunities in 2023. Okay. And from the very beginning of my channel, starting the end of Q1 in 2022, I've been telling people to prepare, right? Stay ready. We don't know what's going to happen, right? I have said, I believe buying incentives and opportunities were going to come back Q3 of 2022. That's exactly what happened. I also said, I believe that there will be some buying opportunities the end of 2022. We've seen that happen in some metro areas like Austin. So, now it's, and you guys know my buy target is my buy target is in 1 month, So, in February. So, man, I found houses, you guys. I found houses that are 15% lower. I can show you guys I have actually saved by renting. But, I still feel like it's too soon. But guys, I found 2 houses that I love. under 2021 values. All right. And that happened in the last 2 to 3 weeks. So just stay ready. Don't get emotional. All right. That's what I'm trying to say. And props to KW. TD Bank, the bank is forecasting that U.S. home prices will fall around 10% from peak to trough. That includes a 5.7% drop in 2023 and another 2% drop in 2024. I hope this goes into 2025, not because I want people to get hurt. I don't want people to get hurt. I want the housing market to reset so it just has fundamentals so that everyone that wants to, right? I mean, you got to earn home ownership, right? Good credit, income, assets. But I'm talking specifically about unaffordability. So I say reset it. I own property. I don't care. Reset it so we can get back to business. I mean, things are just really wacko. Look at Morgan Stanley, you guys. Morgan Stanley, the Wall Street Bank, expects home prices to fall by around 10% between June to and the bottom in 2024. Okay, they expect mortgage rates to be around 5%. Stanley predicts U.S. home prices could crash 20% from top to bottom, including up to 8% home price decline in 2023 alone, if a recession manifests. So let's talk about that real quick, guys. One of the problems that I tried to bring to light, probably I started hitting this summer, maybe fall, but a lot of these research companies that we're going through here, you guys, were not equating a recession into their calculations. So, Morgan Stanley essentially saying, okay, about 5% if there's a soft landing, but if there's not a soft landing, it's going to be 20%. And let me just explain this, you guys. One of the economic indicators, I know unemployment, I get it, okay? But one of the economic indicators to warn us of a recession is the treasuries. It's the inversion of the treasuries, the 10-year and the 2-year. Anytime the 2 years over the 10-year, it's an indication of a recession. I believe out of the last 9 recessions, seven of them were predicted by the 3 and the 2 alone. Now, listen to this. But 100% of the times that the 9-month treasury was inverted over the 10-year, 100% of the times we went into recession. And you guys, it has been inverted. The 9-month has been inverted. The 3-month is so inverted, right? I mean, I looked for a new checking account. I mean, I may switch my money up because checking accounts right now, you guys, they're yielding 3 and 4%. Checking accounts and savings accounts are yielding 3 and 4%. And money markets that track the federal funds rate, you guys, there's an opportunity to make money off your money. And I'm not talking about the stock market. Now, here's Moody Analytics. Moody Analytics expects home price decline 10% if a recession hits. 15 to 20. You guys know I've been covering Moody a lot. Zelman and Associates, guys, and I'm going to quickly go through this so we can do some live Q&As. Back in the summer, the boutique housing research firm forecast U.S. home prices would fall 4% in 2023, and another 5% in 2024. So these forecasts are all over the place. Now, Zonda Home expects home prices to fall 15%. Good for you, Zonda. AEI, director of AEI Housing Center, tells Fortune that he expects U.S. home prices to fall 15 to 20% from peak to trough. Okay. And then we have CoStar expects U.S. home prices will fall around 20%. People who think a 10% drops in home prices are dreaming. 20% is more comfortable. Okay. So KPMG, the big 4 accounting firm experts U.S. home prices as measured by the Case-Shiller Home Price Index. Oh my gosh, this is crazy. To fall 20% between fourth quarter of 2022 and fourth quarter of 2023. This is a bold claim because he's referencing, and thank goodness they're referencing their data. And I know some people have their own algorithm, but they're saying based on Case-Shiller, it's super lagging Case-Shiller. They're saying 20%. In less than a year from now, right? That's heavy. I mean, think about that. 20% is a lot, and by the Case-Shiller. So we'll see. Yield Street. Now, I did a video actually on Yield Street. You guys remember? I think that was our last live video was on Yield Street. By the third quarter of 2023, Yield Street expects U.S. home prices to be 20% below its 2022 peak. Okay, so they're saying in less than a year. They're saying in less than a year by Q3, you guys listen, they're saying by Q3 of 2023, a 20% decline, okay? Crazy, right? I'm just saying that's absolutely amazing. And they're also warning that some markets will be less impacted. And we go over that all the time. Now, Pantheon Macroeconomics, the firm, and they were kind of the leaders, you guys, as far as mainstream media and research firms. I think that we're finally projecting a decline. They're saying they're going to fall around 20%. Okay. John Burns Real Estate Consulting. Look at this, you guys, by 20 to 22%. Okay. So that's it. That's all of them. You know, pretty amazing, y'all. Pretty amazing. Let me switch my camera here. You know, that's going to be it for the article, but you know, as you guys can see, there's more and more people, you know, mainstream media, there's more and more research companies that are essentially predicting continued price declines. Now, you know, so it's very interesting, you guys. Go ahead and shoot some questions. I'm going to scroll to the bottom of the chat so I can just start fresh. Give me a minute, guys. I'm going to scroll to the bottom here. All right, I'm at the bottom. So go ahead and if you guys have questions, that would be, you know, I'll start to answer those questions for you. What I'm going to do, you guys, is I'm going to send the video link here. Let me make sure my earphones are. Just go ahead and send some questions if you guys have some. If you want to talk about credit, you want to talk about DTI, loans, FHA, conventional underwriting, and you know, any of that type of stuff, go ahead, you guys. We'll start that. I'm going to send the link here in live chat, and I will remember I haven't had to kick anyone, but I will do it, you guys, because it's live and I have to be careful. But there's a live chat right there, you guys. There's the link right there to StreamYard. But let's see what we got for questions. Okay, here's a good one. Thoughts in Atlanta? Atlanta, you got just. I think personally, I think Atlanta is going to be one of those cities that gets annihilated, and I think the reason Atlanta, specifically Atlanta, Georgia, gets annihilated, unbelievable investor share. And I believe the investor shares, I believe a majority of those investors are new investors that made poor decisions in investing. All right. That's why I'm saying I think Atlanta is, I think it's going to go down. You know, I think it's going to continue to go down. I don't think that there's very, you know, good investors there. Let's see here. Okay. Question. Here we go. We got a question right here. Okay. Why are selling agents unwilling to show homes if you plan to use your own agent? Because they want the other, they represent the seller. So, and the thing is you guys, the thing is this, most of them are not unwilling. And I could tell you that because I've actually had a client that didn't call me and looked at a house through the listing agent. And that's a very bad thing to do because in my opinion, and they should do this because they represent the seller, they're going to take what you say and they're going to use it against you. So you, in my opinion, as a buyer, you don't never talk to the listing agent, guys. And that's just how it works. So, you know, I hope I answered that question. Here's the thing, Kim. So look it up on Google. I was actually going to do a video on checking accounts because I found some great rates. I mean, literally go to Google and put in checking account, or I'm sorry, savings account yields, right? Top saving accounts yields. And you guys, I'm telling you, like we can now make money off of our money as far as with just saving it. Okay. So you guys, I'm not a financial advisor. Remember that. Now my grandma is in one right now. She went in a money market. She's at about 4 something, and is tracking along with the federal funds rate. She went to Union Bank. All right. A money market account with Union Bank. I believe she had to go in the branch behind the counter to get the deal. Okay. Let's see here. If you can negotiate a 10% drop, does that sound like a decent deal? So you guys remember, all right? I did a video with Michael. We covered this in the recent video, but it doesn't. Okay, you have to be careful, right? You have to be careful because you can't just look at like a foreclosure, or you can't just look at a 10% drop. It has to be 10% drop under market value. If it's like what the builders were doing at first in my local market, is they were just dropping 10%. But the house was still 5% over market value. So to really answer that question, Tom, you need to understand what the comps are. And my advice to anyone that has a similar question is have a realtor do a market analysis on the subject property subdivision going back 2 years. So look at the last 2 years of sales in the subject property subdivision to see if a 10% decline is a good deal, because it might not be. All right. So Cindy, there are self-employed programs, right? And that's generally a non-QM program, a non-QM lender. And generally for self-employment people, you're going to generally want the bank statement program. The bank statement program, it's a higher down payment. Any non-QM mortgage is going to have a 10 to 20% down payment, but there are bank statement loan programs. And the way that those work, guys, is the underwriters use deposits as qualifying income. So an underwriter will look at like 2 years of business bank statements. They'll calculate how much deposits you have and do some calculations, and then figure out what your qualifying income is for your self-employment. And again, that is a non-QM product. It is a bank statement only loan. All right. Okay, so here's a good question. Miami in 2023. I think it's going to get rocked. I think I'm watching Miami. Miami has an incredible amount of demand. It has an incredible, there's so many people going to Miami, but the reason, and there's not necessarily a lot of new construction. I think it's going to go down hard, you guys, because it's number one most unaffordable metro area. And look at California. Look at Southern California. Look at how many metros are on the year-over-year price decline list. I mean, almost the entire state of Cali, right, is on the year-over-year price decline list because, in my opinion, of unaffordability. And that's what I think is going to happen in Miami. Okay, do you see as industry? And the thing is, Mike, is I see it is about local housing market, but I mean, brother, I see pretty much every metro area going down. There'll be some really unaffordable ones that remain unaffordable, of course, but you really, Mike, you got to watch, go to Altos Research, watch your market, get your realtor to work for you, right? You don't have to wonder. My point is, guys, is you don't have to ask these questions. You guys are capable of finding those answers out, and you should. I think you'll be proud of yourself by doing that. Do you anticipate loan underwritings to tighten? Okay, so here's an interesting thing about that question. Didn't want to show you guys I'm drinking. I think that's rude. So anyways, but the crazy thing is, Jeffrey, is loan guidelines have loosened up. Loan guidelines have loosened up. Look at all of the changing in loan limits. On an FHA mortgage, right? On an FHA mortgage, you can go to $2 million loan limit on a high cost area 4-unit property. $2 million on FHA. So, I think if they do tighten up, Jeffrey, that is going to put an even bigger damper on demand. But I don't think they're going to tighten up much, and nowhere near 2009. Remember, the guidelines tightened up back then is the Dodd-Frank. They passed the Dodd-Frank Wall Street Reform Act, right? All right, let's keep going here. Builder. As much as I want to know. Okay. So here's Sonia. Redfin says the price is going down, but in my area, Triangle, the prices are going up. How do you explain that? Well, I would probably explain that by sellers probably offering buying incentives and high demand area. If you're still in a high demand area and the market shifted, shifting into the buyer's market, the first thing that's going to happen, right, is buying incentives, days on the market, price cut. So, probably that area is a high demand area, but I would still question it. I would still look it up because I just have a hard time believing, and I'm not doubting it, but I have a hard time believing that the prices are still going up there. But again, I don't know. I would have to research that local housing market. Okay, cool. Okay, so a lot of Carolina questions. Maybe I may do a video if there's a lot of questions about North Carolina to kind of research that a little bit more. Definitely some great questions, everyone. I just want to let you know I appreciate your questions. I think they're great questions. I'm trying to make my way quickly. Also, between the seller and buyer, what are the max amount of points that can be bought on a 30-year mortgage? It depends on the loan amount because there's high cost loans, high price loans. The lower the loan amount, the less costs are allowed. The higher the loan amount, the more costs are allowed in a dollar for dollar number. But and also the type of loan. So I'm just going to tell you the maximum in seller contributions for each loan. So conventional maximum seller contributions is 3%. VA is 4%. FHA is 6%. And you can use the 6% to buy down. And you guys, they're not really buying down the loan. I hope you guys, they're not really buying down the rate. They're putting money in an escrow account, right? So they're putting money in a savings account that's designed to help you pay your mortgage payment, right? It's not even a buy down. So they're just putting money in a savings account and helping you pay the mortgage for a period of time. Very interesting. I have good credit and a job, thinking of choosing an FHA loan just to get a low down and seller contribution. Is this a good thing? Haley, the thing is every situation is different. But the thing with FHA is it's the only reason you don't want FHA for the sake of argument is mortgage insurance. That is the one thing about FHA. So here's what I want to say, Haley, and this is something that I want you to talk to your loan officer about. I want you to see if you can switch to a conventional mortgage called Home Possible or Home Ready. Home Possible and Home Ready actually allows you to put only 3% down. And depending on if it's Fannie Mae or Freddie Mac and the program, you also get an extra discount on your mortgage insurance. The criteria is generally you have to be a first-time home buyer and you can't be making too much money. So I want you to go and ask them about Home Possible and Home Ready because it's actually a lower down payment than FHA, although you only can do 3% in seller contributions as opposed to 6%. Great question. I don't think so. I don't know. I don't think so because I just don't think so. It's a specific buyer, and I think I don't know though. I don't know. I'll be watching. I think they're going to be more stable. And my thought is those communities will be more stable. Okay, how long does the bankruptcy affect your credit when applying for approval? Will FHA be better than conventional? Yes. So if you, and there's a link here. So Sean and Wendy, big shout out to you guys. Thank you for all your support. I love you guys. I'm glad you're learning. I love how pumped up you guys stay. But I had a bankruptcy, and again, it depends on many things. Usually 2 years. You're going to want to probably stick with FHA. FHA is looser, way looser when compared to conventional when it comes to BK. You kind of want to be 4 years out. What really matters, Sean and Wendy, is what you do from an underwriting standpoint. What matters is what you do after the BK, right? So sometimes you could do up to 2 years after, but you have to demonstrate that after your bankruptcy, you try to reestablish your credit, essentially, okay? So if after the bankruptcy you went out and try to reestablish your credit and you didn't have any late payments and anything like that, or any derogatory after BK, it's a lot looser. So again, they look at the BK, but they also look at what happens immediately after the BK. All right, really important stuff. But FHA is going to be your looser loan for sure. How about, Boise's getting hurt. Boise's getting hurt. I think it's a lot is going to be revealed as we go into 2023, you guys. But obviously, Boise is, it's suffering. Inventory has shot up. It's not as bad as Austin. I drove out to Austin. It's not as bad as Austin. Honestly, I think it could be great for some people. I think it could be absolutely great. Look at how many decades and how many years did we go through where we got no money we got no interest on the money we saved. In the 80s and 90s, people were able, even before that, but people were able to retire by taking the money that they saved and putting it in a savings account. People were living off the interest, and that disappeared. That was gone, right? So fast forward to today, we have options. And I think that T-bills or money markets and things like that, I think it's a safe place to put your money to make money. We know the stock market's all over the place. We know the housing market's all over the place. There are money markets out there that are 6 months. Your money is only locked up for 6 months. Some of them are a year. I think quite frankly, it could be great. I'm not advising anyone. I'm just saying personally, right? How long till the refi? How long till refi and the two for mortgages can or won't make payments? I'm seeing some locally already. Okay. How long till the refi? Okay. So what we're talking about, Tony, it depends on, I think this one, so he's saying that the people existing homeowners that refinanced into low rates is what he's saying. I believe. And then how long is it going to take those people to stop making the payments? We don't want people to get hurt. I don't want people to get hurt. I don't want people to get foreclosed. But Tony, I think that depends on the unemployment. I think it depends on the unemployment and affordability. If someone gets unemployed, it doesn't matter what rate they have. They can have a 2% or a 6%. And that's what I'm trying to warn people about. I mean, for that reason alone, there's just a lot of dust in the air, you guys. All right, let's see. We got another question here. Thank you guys so much. I'm going to go for about an hour. Question. Thanks for all you do. Thoughts on Orlando, Florida by this year? I haven't been focused much on Orlando, but I would start by tracking down new construction. I would start by tracking down new construction. And I will say, although I don't feel comfortable enough saying that about Orlando, because I would want to do research, and not just spit out something. But Florida got hit hard last time. You guys remember that. Florida got destroyed in the last crash. I think it's going to get destroyed in this crash. Obviously, the migration's bad, but look at all the second houses. Look at all the vacation houses. Look at all the vacant houses in Florida. I think when the recession hits, the meltdown hits, I think Florida is going to be I think it's going to be rapid. I think Florida is going to be one of the most rapid price decline states in the nation. And right now it is the number one state in surging defaults. Right now, Florida is the number one state in surging mortgage defaults. I think so, though. But to answer this question, I do think so. All right, let's keep going here, you guys. Another Tampa. Okay, this is a good question, you guys. So I live in Houston, and Houston is traditionally a lot more stable than the rest of the nation. So the thing is I've already seen, John, I've already seen a decline in my house, and I've been able to demonstrate that, I think, to the viewers by doing our local market analysis. And we have way more now listings that are under 2021 levels. So I already see a decline in my housing market, but I wish there was more decline, John. And I suspect, especially as rentals keep flooding our market and my local market, it's being flooded right now with rentals. I suspect that it's still going to go down. So what I'm saying is I believe even if I buy in February and find a great deal, I still think the market is going to continue to go down. But I don't think Houston is going to go down like Austin. I don't think even close. I think Austin is going to be like probably the number one metro area in the nation with price decline. But no, I don't think Houston touches that. But I definitely think there will be correction, continued correction and crash in Houston as far as prices. Okay, let's keep going here. I'm trying to go quick, guys. I just want to cover as many questions as possible. Why would you say when rent is higher? Oh, so the thing is like generally, if your mortgage is lower than your rent, it's a no-brainer, right? Generally, if your mortgage is lower than your rent and the home is even bigger than your rental, it's a no-brainer. And that's why I keep saying like rent is a lot of wasted money. It's not all wasted money, right? I had to correct myself because I'm renting, but it is a large waste of money. But if you guys can find a house in a mortgage that's lower than your rent, it's normally a good idea. But again, my caution right now, it's the same caution. I'm specifically talking about price decline and being trapped in your house and something unexpected happening. And that's really what I'm saying is if you buy right now, right? I know different reasons to buy. There's different local housing markets, but if you buy right now, you should have the expectation that if I buy, it is possible and likely I will be trapped in my house for a period of time. And if something unexpected happens, I may be in danger of foreclosure, right? And that's really what I'm saying. It happened to me. I feel like I have a right to say it, right? I've lost everything. I've already lost everything, you guys, and I don't want that to happen to people. I don't want people to have to learn the hard way. Here's something from Jeff. Oh, so here's Patrolman. He's getting 3.75% on his account. You guys see what I'm talking about? Is anyone watching checking accounts and savings accounts? It's crazy how much money they're giving. Let's see what Jeff says. Love you, Jeff, obviously. 7 to 10% inflation for 3 years mixed with negative 10 nominal pace of 5% wage growth for 2 years. That's almost a 50% decline in prices, although it seems like prices are only down. Yeah, so Jeff, I love Jeff, you guys. And let me explain what happened. And you guys that have been watching my channel know that I've had Jeff come on our channel, and I've talked a lot about him. And the reason is you know, the channel has grown so quickly, you guys. I haven't been able to stay on top of the comments as much as I'd like, and that hurts my heart because I want you guys to know that you are important to me, and what you're asking and feeling and saying is important to me. But with Jeff, it's crazy. He was one of the persons from the beginning. I always loved him. We didn't always agree on stuff, but he was super respectful. He always used to explain stuff. And one day I got really freaked out because he was going to go out and put an offer on the house. And this was, I think, Jeff, and maybe you can remind me, I think it was around September. Was it September? But anyways, he freaked me out and I felt like a failure. All right. I was like, if Jeff puts on a house and I fail as a content creator. So I was like, you know what? So I look at him as family now. And that's really just what it is, man. I mean, I don't know what else to say. So, honestly, I'm gauging myself by what Jeff does. So now that you guys know that, I'm myself as an individual, as an efficient content creator and an influencer, I'm watching Jeff. And the reason, and the other thing, guys, he's in a really difficult housing market. But he's just elevated himself to be just have tremendous purchasing power. Jeff has tremendous purchasing power. I'm sorry, I didn't mean to go on and on about Jeff. Jeff, I love you. Let's move on. What product are you using to light the cabinets behind you? Those are sweet. I'm going to tell you right now, Travis, don't do it. Okay, I messed up. I'm renting my house. I hate the fact that I have to charge every one of those LED. Those are like little boxed LED lights that I can change the color. Huge hassle, man. I have to charge every single one. I hate it. So, and the reason I'm doing that is I don't want to put like permanent construction because I'm renting here. So, and that's the other thing, like my mental stability, you guys, I really want to set up my studio differently. That's okay though. Are there any mortgage loans callable or can be, yeah. And here's the thing I want to tell you guys. This is good because I think about this. So I'm not going to use any names here, but I got in a disagreement with an investor, right? And then he's just started getting personal and petty. And I was like, I'm done with you. But his argument was like subject to, right? Subject to. And subject to is where an investor or a buyer essentially finds a distressed seller and they convince the seller to violate their existing contract with the lender, and they start making the mortgage payment for the seller. They kick the seller moves, they start renting the house out, they start cash flowing. Here's the thing, you guys, if any of these recent investors stop making their mortgage payment on the subject to, the seller gets destroyed. The previous seller gets destroyed because it's still on their credit. Subject to, although everyone's doing it, you could change like this. And I'm not going to invest with subject to because the lender can accelerate, right? They can accelerate it. And if we're in a downturn and an investor's paying on a 2% loan, the lender finds out about that, the lender can call the loan due. Why wouldn't they if they can get 7% instead, right? I'm just saying, you guys, subject to, and I think that's what he's saying. But Jeffrey, anytime there's a sale or change of title or something like that, it can alert the lender, and the lender can accelerate the due payment. And that's why that's why I personally think subject to is not good. It's not good. I don't think it's good for anyone. I think some situations have turned out well, but I'm not going to do it, and I'm not going to recommend it. Take a look at this. Oh my gosh. So this is my point. So Jeff is doing this right now. So Jeff has a money. Oh, this is crazy. You guys, Jeff, I don't know who you're using, man, but this is what we should be doing with our money. In my opinion, I have liquidity. I'm behind the 8 ball right here, man. So Jeff is getting in his money market 4.37%, and it takes him only 24 hours to get his money out. Jeff, is that with a fee? Like how that's, and what bank are you using? That's solid, you guys. That is solid. All right, I'm going here. Let's look for some more questions here. Take a look at this, you guys. Take a look at this question. This is also another good question. All right, we got a couple questions coming up. So what are your thoughts on buying a fourplex as an owner occupant? So if I can reverse time, go back in the time-space continuum and go back into the future where I lost everything. Well, first of all, I'm not going to lose everything. But honestly, If I go back to my 19, 20, 21, I would probably buy a fourplex with an FHA loan for 3.5% down, and I would rent out the other 3 units, live in the 1 unit for a year, and then move out. That's probably what I would have done. Don't hate me, you guys. I've learned so much since then. But if I like the idea, I like the fourplex idea. You don't even have to rent. It could be other family, but I think it is amazing that FHA allows us to buy a fourplex as an owner occupied property for 3.5% down. And I'm not trying to upset people. I know we have a rental problem and a institutional investor problem, but I'm just trying to be unbiased. Looking at my past, I think that could be a great investment for some people. I can't do that now. I have children, but honestly, I've thought about it because I found like beautiful fourplexes in my local housing market. So I've already done the numbers on that, but my kids, so I'm not going to do it. Great question. Okay, this right here, you guys, is what I'm most afraid about. I don't want you guys to take me the wrong way. Really appreciate that super chat. I'm going to get to that here in a minute. I'm going to get to the super chat next. Thank you for that. But I really need you guys, let me speak with some specificity on why I would be purchasing next month if I think house prices are still going down. Okay. The number one reason is I am a well-positioned, well-qualified buyer, have like pretty much no consumer debt. I have 6 months of savings, right? I'm a well-qualified buyer with an expectation that I could be trapped in my house and with a plan to basically get through that hard time. And and really what it boils down to, man, is it doesn't make sense for me to keep renting because now I've found houses that are low enough now to where I think it's actually a great deal. And also there's the mental health, there's a bit of mental health when, people have different reasons to buy. And I want to move on with my life, you guys. But again, I want to be very cautious because I don't want people following me, right? I'm specifically saying, don't follow my lead. I'm doing this mental health, well-positioned buyer. I've already calculated my rent loss, from doing this. So I'm okay with not trying to time the bottom on my primary residence is what I'm saying. Okay. And I want to make that clear, but I am no way suggesting that people do the same thing. I've been watching my local housing market again, and I understand the trends. I understand what a great deal looks like, and I will lowball, right? I'm going to lowball, but I just want you guys to be really, really careful on what I'm saying. I am not saying that you guys should follow me. If you're well qualified, and you're in a bit of a rush and things like that, it's your primary residence. Don't try to time the bottom of the market. Do it wisely, but very, very cautiously. And that's why I hope I answer that. I really hope I answered that. But I need to move on with my life, man. And it's my primary residence. I'm not trying to take over the world. I don't need a whole bunch of money. I want to just get on with my life, quite frankly. But there's no way in heck I'm going to do that buying an overpriced house that I hate, right? So that's why, man. I'm going to be very careful, though, man. Don't worry about that. I'm going to be making sure that people understand exactly why I'm doing what I'm doing, and I'm going to make that point. Okay. So here's Mike. Price is going down as mega sites are bringing in industry. Mike, I don't know, man. Anytime here's the thing that's very intriguing about local housing markets. Anytime there's an influx in jobs, usually the housing market explodes, right? Normally, right? But my question is, will that offset the distressed housing market that we're in? Will that will that offset the quantitative tightening? I don't think so, but it's possible. Okay, let's keep going here. The answer to this, are the rates higher on the bank statement only program? This was a self-employment program where the underwriter reviews your deposits to calculate qualifying income for loans. And yes, obviously the rates are a lot higher. They're a lot higher, not a little bit. And yeah, he's taller, man. He's taller. Darth Vader should be taller. Do you know what Darth Vader should be taller. I'm just going to say that, right? All right, here's a question, you guys. I'm going to wrap this up here in a minute. On my question about the agent, I just want to look before I can get an agent and drag them 200 miles across Texas. There should be agents in that local housing market. So It's dangerous, man. So he's saying is like he doesn't want to drag his agent uh, to follow him. He wants to look before bringing the agent because the agent has to go 200 miles. It's just I still can't necessarily recommend that because I understand the game and I understand the listing agent game, and I'm telling you guys, they're looking for everything you can give them. They're looking at your nonverbal communication. They're looking at your reaction to things. They're watching you to like try to determine how desperate you are to buy that house. All right. So if you're comfortable with that, by all means. But I'm just a warning. That's all. Great, good question. Good question. Okay. I don't. I mean, it's just a way to separate your assets. I'm not one to kind of just jump into LLCs, but it is a good way to, again, separate your assets and build credit as well. You can build business credit that way. I don't do it. I do a Schedule E on my 1040 tax return, and I file that. But I've done incorporations. That's just not my goal, right? I'm not, that's not my goal. I don't think so. I don't think Dallas is going to crash like Austin. I think that Austin is going to be the leader in the entire nation. I mean, the amount of building and inventory is just quite shocking, you guys. So I'm going to wrap this up here. Let me go to the super chat real quick. Where's the super chat? I'm trying to pull that super chat out. Oh, here we go. Appreciate you a lot, man. Oh, no question. Really appreciate that love, man. You know, save your money. Like I said, do not send me money, you guys. Do not. I will feel bad. Don't make me feel bad, please. I want you guys to be saving your money, right? I'm constantly preaching, save your money, right? Don't go out to eat, right? Don't go to the movie theater. Stop using your credit cards, right? But I am honored, man, and I really appreciate you. Thank you so much for that. Okay, you guys, I'm going to wrap it up here. Let's see what else we got. Let me just kind of comb through this real quick. Some good questions here. No one jumped into this video today. You guys afraid to get on the video or what? Is it scary to get on video? Is it scary to you guys? No, I can't believe no one came on today. I sold our primary in 2020 before the peak, good equity, invested it in rentals, making enough to cover my rent in Chino. Riverside is on the year-over-year price decline list. What I would do, I think she's asking if she should keep renting or should she buy. You have to pencil that out. I penciled it out. It depends on lease term. Depends on, you know, if you can break your lease, what the fee is on breaking the lease. But I want to just say it like this. I don't think people should rush. I definitely think you should be ready though. Because again, we're not in control. The Fed is. All right, guys, I'm going to get out of here. Let me just switch this self-employed 12-month bank statement to prove your income for a loan. How is it calculated? So it's calculated essentially by deposits. They take out certain deposits that are not income deposits, but essentially, Sean and Wendy, they calculate 24 months of deposits and then divide it by 24 months to get your monthly income. All right, so they look at deposits. All right, guys, I think I'm gonna get out of here. I just want to let you guys know. I'm gonna wrap this up, you guys. I know there's a couple more questions, but I gotta get going. I have to do some videos. I have no videos for you guys at all, so I'm gonna be trying to do videos today, you guys. I have been just sitting back, you know, at the start of 2023, and I've just been asking, what do I do next, right? You know, I don't want to just read articles. You know, I really, because I understand why people are watching. So I really want to stick to really the value. I really want to stick to the solution. But most importantly is I want to teach you guys how to find good deals, how to find great deals. I'm a little bit afraid to do that right now because again, it's not that I don't trust people. It's just that I understand that people will only hear certain things that I'm saying and they may make horrible decisions. So, you know, I just been sitting back, you guys, just really trying to, you know, how do I help you? How can I provide new value that you haven't got before? I don't want the repetitiveness. But you know, what I'm saying, guys, is I'm going to try really hard to bring you guys just extra special value. You know, it's really hard to do that when real estate's so boring. But other than that, you guys, I want to say from the bottom of my heart, thank you for taking the channel to where it's at. I never expected this type of growth in my wildest imagination, you guys. I don't want leads. I don't want to sell people's houses. I don't want to help buyers as far as, you know, representing them. I don't want loans. My goal here is awareness. That's it. What I do want is I don't want you guys to go through the pain that I went through. And I think that's fair, right? I think it's fair. And I do want to be data driven. I understand that I'm passionate. I understand, but I do that because I want you guys to listen, right? I know that's, as an educator, I understand that when someone is genuine about their education and like likes it and enjoys it and engages, it's more effective. And that's why I do the things that I do. But again, you guys, I can't believe that you guys took me to where I'm at. And that's, again, why I want to keep doing these lives. I am so blown away. I'm so humbled. I'm sorry I'm rambling. But other than that, guys, all right, thank you. I hope you guys got some value, insights, and perspective in today's video. And if you're out there investing in real estate, I do wish you luck. And I hope you win. The thing with doing that, you guys, is I'm still live and I have to like get my finger over here and hit